All right, let's get right into it. Today, we're looking at a pretty fascinating ETF that's been making some serious waves. It's the Goldman Sachs S&P 500 Premium Income ETF, or GPIX for short. And, it's trying to answer that age-old question that so many of us have. Can you actually get high monthly income and solid market growth all from one investment? You know the drill if you're an income investor. For years, it's been this classic trade-off. You could go chasing those really high yields, but you'd probably have to kiss your growth potential goodbye. Or you could shoot for growth, but then your actual income stream would be pretty tiny. It's a frustrating choice to have to make. So, does it have to be a zero-sum game? Do you really have to pick one lane and stick to it? Well, that's the exact problem that a whole new generation of funds is trying to solve. And this one, GPIX, has a very, very interesting answer. And that's where GPX comes in. It only launched back in October of 2023, but wow, it's been getting a ton of attention for its performance. So let's just look at the numbers, because they really do tell a story. Okay, first up, the 12-month total return. As of September 2025, we're looking at an impressive 16.1%. Now, for a fund that's built around paying out income, that kind of growth is exactly what gets people to sit up and take notice. And that performance isn't just a thing of the past. If we zoom in on this year alone, the fund's already up a super healthy 8.8%. It kind of shows that this momentum has been steady, not just some one-time flash in the pan. But here's the number that really makes you go, whoa. Since it started, GPIX has delivered an annualized return of 24.6%. Just let that sink in for a second. For a fund designed to cut you a check every single month, that is a truly powerful growth figure. So, what does this all mean in plain English? It means investors are kind of getting the best of both worlds. Their investment is actually growing in value, while at the same time they're getting that steady, reliable paycheck from the fund's distributions month after month. Naturally, when you see performance like that, the next question is, how? How are they doing it? Well, the secret sauce is in its dynamic options strategy, and it's an approach that the analysis we're looking at calls superior. So let's break down what that really means. The key term here is dynamic coverage. See, unlike a lot of other funds that might have a fixed or static strategy that never changes, GPX is built to adapt. It actively changes how much of its portfolio is covered by its option strategy, flexing anywhere from 25 all the way up to 75%, depending on what the market's doing. And here's the logic, and it's pretty brilliant. When the market gets all choppy and volatile, GPX cranks up its coverage. It sells more call options to generate a bigger income stream. But, and this is the cool part, when the market is rallying and going up, it does the exact opposite. It pulls back on the coverage, which lets the fund capture way more of that upside growth. It's like having two different game plans for two different types of markets. Okay, so that's the theory. But how does this dynamic strategy actually hold up against the competition? Let's put it head-to-head with two other really popular funds in the space, JPI and SPYI. Looking at this chart, you can spot the crucial differences right away. Yeah, all three have pretty similar yields, somewhere in that 7 to 9% range, but the style, that's the real game changer. GPIX is dynamic. JPII and SPYI, they're mostly static, and that directly affects how much of the market's gains they can capture. It's why GPIX gets marked as higher on upside capture, while the others are lower or limited. The whole point is that GPIX is built to grab more of the good stuff when the market's hot. And here's the bottom line from the source material. The huge advantage for GPIX really kicks in during a bull market. See, those static funds might cap their own gains way too early. But GPIX, with its flexible strategy, can keep running with the market so it doesn't leave all that potential profit just sitting on the table. Of course, let's be real, no investment is perfect. There's always a flip side. For a truly balanced picture, there are a few key things you've got to keep in mind with this one. First off, the fund is still the new kid on the block, so its track record is less than 2 years long. Second, remember, while it captures more upside, that growth is still capped by its options strategy. Third, the income it pays out can have some unique tax implications you need to be aware of. And finally, its use of derivatives is central to how it works, but that does add a layer of complexity. So these are all really crucial things to weigh. So you've got the strong performance, the unique strategy, and the risks. What's the final takeaway for you, the investor, looking at your own portfolio? It really boils down to this one simple, memorable line. If you're an investor who already owns or just appreciates a fund like JPI, then GPIX, with its more adaptive strategy, could be an even more compelling choice for hitting those goals of both income and growth. And that leaves us with one final thought. In a market that's changing all the time, GPIX makes a really strong case that a rigid, fixed strategy just might not cut it anymore. It really poses a bigger question for all of us. When it comes to generating income, is adaptability the new king of the hill?